go ahead, Mr. Roberge.
Thank you, Whitney, and good morning, everyone. On the call with me today are Chris Bailey.
Finally, the process to secure a partner for a material interest into activities or services. Inter Pipeline remains highly focused on the unprecedented decline in global energy prices and the COVID-19 pandemic. Inter Pipeline is committed to the health and safety of our workforce, and personnel continue to work safely throughout our diversified asset base and at major project sites, including the Heartland Petrochemical Complex, without material disruption to activities or services. Inter Pipeline remains highly focused on the advancement of the Heartland Petrochemical Complex. Through rigorous sanitation efforts and robust controls in place to protect workers, we have been able to successfully increase productivity and currently have approximately 2,600 people on site every day, over 40% higher than Q1 workforce levels. During the quarter, we invested $238 million on the complex, with approximately $2.7 billion spent on the project since inception. I'm pleased to report that the project remains on track according to the revised $4 billion budget and scheduled in-service date of early 2022. Finally, the process to secure a partner for a material interest in the Heartland Complex remains active, and we are investing significant time and resources into this effort. We expect it will take at least until early 2021 to conclude this process, and there can be no assurance that a transaction will be completed. Moving to the conventional oil business, during the quarter, we completed Phase 1 and 2 expansions of our Central Alberta system. Phase 2, the Viking Connector, was completed on April 1st and included 75 kilometers of pipeline to connect Inter Pipeline's Bow River and Central Alberta pipeline systems. In a normal operating environment, Phase 2 is expected to ramp up to between 10,000 to 15,000 barrels per day of throughput volume. At the end of June, we completed the final component of Phase 1, which included the construction of two 130,000 barrel storage tanks at Stettler. Both phases were completed on time and within budgetary targets. Lastly, in conjunction with Inter Pipeline's ongoing board renewal efforts, Mr. Richard Shaw, board chair, and Mr. Brent Sangster have announced their intentions to retire from Inter Pipeline's board of directors effective our next annual meeting in May 2021. I would like to congratulate Ms. Margaret McKenzie, who Inter Pipeline intends to appoint to the role of board chair at the next annual meeting. Ms. McKenzie has served on Inter Pipeline's board for 5 years and brings over 30 years of experience in the energy sector. Now I'd like to turn things over to Brent to discuss our financial results and recent financing activity. Please go ahead, Brent.
Well, thank you, Chris, and good morning, everyone. During the second quarter of 2020, Inter Pipeline generated funds from operations of $184 million or 43 cents per share. As expected, the lower commodity price environment negatively impacted our NGL processing and conventional pipeline financial results, while our oil sands transportation and bulk liquid storage segments continued to remain strong. Inter Pipeline's oil sands transportation business continues to provide stable cash flow that is underpinned by long-term cost of service contracts that are not materially impacted by throughput volume or commodity price fluctuations. This segment generated $152 million in FFO during the quarter, representing a $2 million increase compared to Q2 2019. Our conventional oil pipelines business generated quarterly FFO of $26 million versus $50 million in the comparable quarter in 2019. Conventional results were impacted by a 45,000 barrel per day reduction in throughput volumes to 140,000 barrels per day during the quarter. In addition, midstream marketing activities were impacted by weak blending margins and generated approximately $1 million in adjusted EBITDA during Q2 2020. For the full year 2020, we expect our midstream marketing operations to generate between $5 million and $10 million in adjusted EBITDA, subject to pricing differentials, volumes, and corporate cost allocations. Broadly, the outlook for our conventional business has improved, with July's average throughput volume increasing to approximately 157,000 barrels per day. Moving to the NGL processing segment, FFO for the quarter was $37 million, down from $72 million in Q2 2019. Financial results were impacted by lower realized olefinic and propane plus frac spreads, partially offset by an improvement in realized paraffinic frac spreads and strong operational performance. The straddle plants are continuing to receive high inlet volumes of approximately 3.1 billion cubic feet per day, and sales volumes at Redwater continue to be strong at nearly 35,000 barrels per day. In the near term, results from this business could be adversely impacted should a lower commodity price environment persist. Our bulk liquid storage business generated 34 million in FFO during Q2 2020, representing a 27% increase over the comparable period in 2019. The increase is a direct result of higher demand for oil product storage, particularly in Denmark. Consolidated utilization rates have demonstrated a material improvement, averaging 98% in the second quarter of 2020, up from 83% in Q2 2019. Inter Pipeline anticipates strong utilization rates to continue throughout 2020, with increased demand for storage infrastructure. Turning to the balance sheet, Inter Pipeline remains committed to maintaining financial flexibility. In late April, we successfully closed a new $1 billion unsecured revolving credit facility and extended the maturity of a $500 million term loan for 2 years to August 2022. On June 1st, we successfully completed a 7-year, $700 million medium-term note offering. Proceeds were used to repay $500 million of notes that matured in July and reduce indebtedness under our $1.5 billion revolving credit facility. So as a result of our efforts to enhance our financial flexibility, we are well positioned to continue funding our capital program. As of June 30th, Inter Pipeline had $2.5 billion of undrawn committed credit available and approximately $290 million in cash. We also ended the quarter with a net debt to total capitalization ratio of 42.5%, which is significantly below our maximum bank covenant level of 65%. So this concludes the formal portion of the conference call, and I would now like to turn the meeting back to Whitney to open the floor for questions. Thank you.
If you would like to ask a question, please press star, then the number 1 on your telephone keypad. We'll pause for just a moment to compile the Q&A roster.
Whitney, go ahead.
Yes, your first question is from the line of Linda Ezergailis with TD Securities.
Thank you. I'm wondering if you can help us understand in your NGL business what the forward pricing is looking like, and kind of the ramp up of recovery for not just the back half of this year, but kind of what you're seeing early on for next year in 2022.
Hi, Linda, it's Jeremy. I don't know if you can you hear me?
Yes,
I can. Operator, return, please.
I apologize, that cut out earlier. The balance for the forward curves for our Cochrane frac spread, this is US dollars for US cents per gallon. For the balance of the year, we're looking at around 36 cents. And for 2021 full calendar year, looking at around 32 cents. And that compares to a current spot rate today of roughly 38 cents per US dollars per US gallon.
Okay, thank you. And maybe I realize there's some sensitivities around your HPC sale process, but can we get a sense of, with some of the reopening that we're seeing in Canada, maybe not south of the border, are any discussions accelerating, or are things still fairly slow? And have the nature of the discussions maybe improved or become more active with some of the commodity price recoveries we're seeing, and economic maybe a bit more optimism than earlier this year? Can you comment on any context that you can provide? Hello?
Excuse me, this is the operator. Your conference will begin momentarily. Please stand by. Hi, Brianne.
Hello.
Yes, you're back on the call. You may resume.
Yes. So are we heading forward with the Q&A, please?
Yes, the participant is still in queue. She's still connected.
Can you please re-announce who it is, the name of the individual
Linda?
and the company, for the benefit of our speakers?
Linda Ezergailis, your line is open.
Thank you. In terms of the context that you might, additional incremental context you can provide around the HPC sale process, I'm just wondering if the nature of discussions has changed in any way in terms of volume or content or anything else, just to help us understand how that might be progressing.
Hi, Linda. It's Chris. Hey, sorry about the long delay there. I'm sorry, is your question about the sales process of finding the partner or the process of securing take-or-pay contracts?
Well, we could discuss both.
Well, when it
Any
comes to securing take-or-pay contracts, the nature of the discussions remains essentially unchanged. Clearly, the near-term forecasts, particularly the spread between polypropylene and Alberta propane, has compressed with the drop in commodity price, particularly polypropylene. But our long-term outlook on that spread remains intact. So we continue to have constructive conversations with potential counterparties and continue to move that ball forward. When it comes to the process for finding a partner, we don't have anything more than we can say beyond our prepared remarks and what's in the news release that was issued yesterday. The process remains active. We're pleased with the level of interest that we've seen from a variety of counterparties, and it will continue to remain to be the major commercial focus of the business here for the balance of the year.
Thank you. And maybe just as a follow-up, I realize that the HPC sale process is a focus, but to the extent that your storage business is likely not a long-term core holding, I'm wondering if you've, in the interim, received any inbounds for other assets, and if the organization might have the interest and capacity to potentially start ramping up either potential JVs or outright sales of other assets in parallel with the HPC process, or would that only be decided on afterwards, given organizational capacity and other considerations?
Our view on other potential asset transactions remains unchanged from what we discussed in May. Opportunistically, we would definitely look at any compelling offers that we may receive for our storage business. We've stated many times it remains non-core, but it's not a top commercial priority right now. The focus is HPC, and that will continue partnering for HPC.
Thank you. I'll jump back in the queue.
Your next question is from the line of Jeremy Tonet with J.P. Morgan.
Hi, good morning.
Morning.
Just want to touch base on the conventional segment a little bit here. 3 systems were down anywhere from kind of high teens to about 40% quarter to quarter for volumes, and just wondering if you can quantify how much of that was due to shut-ins versus competitions or natural declines. Just when do we expect to see volumes return to something close to prior, or what's the new baseline to which we can climb back to achieve?
Jeff, do you want to handle that question?
Sure. Yeah. Hey, Jeremy. It's Jeff here. We the vast majority of what we've seen cut back, our drop since I'll say Q1, is all really due to the pandemic and the supply demand with producers shutting in. Very little competitive draw on that. And as you heard Brent say, we are already seeing a pretty strong recovery. I'll say stronger than we expected. So Q2 was certainly our low point, and we're optimistic that that'll remain the low point as we continue to grow the volumes back. I think Brent mentioned 157 is what we're seeing for July, and we're seeing that grow into a little further now as we move into Q3. But to address your question, we expect to get back to where we were Q4 19, Q1 20, but that's probably going to take at least into 21 as we move over to Q2. So we're probably a little less than a year anticipating in our forecast to get back to those levels.
Got it. That's helpful. Thanks. And then in the storage segment, it looks like utilization was very strong, but I think that the rates were a little bit less than what we were thinking, not as much change given maybe some of the contango benefits that could have materialized. And so just wondering what you think is possible timeline for higher rates to make their way into revenue, or how should we be thinking about that?
Oh, hi, Jeremy. It's Brent Hagee. I'll take that. Yeah, I think maybe part of the reason for slightly decreased rates is even though we've had fairly high utilization, the other thing that was impacted was throughputs. And that was largely, let's say, for some of our terminals, let's say like Grays, which is just outside of London, which provides diesel fuel and gasoline and that type of thing into the greater London area. So, I think as we start seeing a bit of a recovery in the economy, we'll start seeing some throughputs come back up. And I think that will probably start helping on the rates. I will say, though, that, in this environment, that business continues to perform quite well. And, our outlook still looks pretty strong for it. So that's probably what's been going on with that business.
Got it. That's very helpful. Thanks. And just if I could, want to dive into the cost savings a little bit. And you talked about the reductions organization-wide. And I think there was a number of $100 million that maybe you had said before. Just wanted to see kind of, the cost savings that you guys are achieving here. How durable are those if we look at 2021 plus?
It's Brent here again, Jeremy, and I'll take that. Yeah, the previous guidance that we gave, let's say last quarter on the cost reductions, we're still standing by that. And I think you can see, like, even in our, let's say, even particularly in our G&A costs, I think we're seeing the benefits of those activities starting to flow through. Certainly as we head into 2021, we're going to try and maintain as much of those cost reductions as we possibly can. It's going to be very, very important, as we head into 2021 to make sure that we're being very diligent around reducing our costs. That being said, we do have a large project being HPC, where we are incurring some G&A and operating costs. Right now it's just in the G&A costs for operational and business readiness. But certainly we are looking to maintain as much as possible these cost reductions going into 2021.
That's very helpful. And just wanted to clarify real quick. I think you referenced a 36-cent spread in response to one of Linda's questions. And what was that with regards to, if I heard that number correctly?
Jeremy, it's Jeremy. That's in relation to our Cochrane frac spread on C3 plus volumes.
Great, very helpful. That's it for me. Thanks.
Jeremy, it was for the balance of the year for 2020. The forward curves for that same C3 plus frac spread was about 32 cents for 2021.
Got it. Thank you very much. That's it for me.
You're welcome.
Your next question is from the line of Ben Pham with BMO.
Okay, thanks. Good morning. I wanted to talk about, so as you went through Q2, you had some puts or takes that you're managing, and oil sands was quite resilient, storage was strong, and NGL processing. I wanted to check with you. There's some change in volume composition. Volumes are strong. Are you basically, or can you basically move and change the slate around pretty easily to really maximize and capitalize on really different pricing trends, or in other words, maybe reduce the downside that you're seeing in these high level spec prices?
Yeah, hi Ben, it's Corey here. In our NGL business, the composition is kind of twofold. In our extraction business, the composition is made up of the composition that's flowing through the gas near our plants, adjacent to our plants. And what we saw in Q2 is a higher composition, more as a result of field gas processors re-injecting liquids in because it was uneconomic for them. So we saw an increased composition. We can't really control that, and we basically just extract the liquids that flow by our plant. And that's similar with our off-gas business. Our off-gas business extracts liquids from the oil sands operations, and depending on their operations, drives the composition. So our facilities can't really dial that in to maximize based on pricing.
Just maybe one thing to add there. At Cochrane, we do have the ability to re-inject. For example, if the C3 Plus is uneconomic to produce, we can't put it back in the gas stream. We don't have that ability in our off-gas business. It's a must-run facility because there's no place to re-inject the liquids once they're fractionated.
Okay, all right, understood. Can I ask you also about the credit metrics? And you got S&P scrutiny right now. What is the main metric you guys look at as you speak with agencies and your own internal modeling as you look at the next 12 to 24 months?
Well, I think it's Brent here, and yeah, let me take that question. So, we do continually have discussions with the rating agencies. Right now we have ratings from S&P and from DBRS, and they were recently reconfirmed when we did our $700 million medium-term note issuance. So to give a little bit of color around the dialogue, obviously, what we're pointing to is sort of the path that we would have, let's call it that, in terms of improving our credit metrics. Certainly the big one is HPC coming online and starting up in 2022. And, as you've seen, we still are holding our long-term average annual EBITDA expectations about $450 to $500 million a year. So, once HPC comes on, that's going to materially improve our credit metrics. The other thing too that we're talking about, and Chris has already talked about, is the process that we're going through to find a partner for HPC. That would materially improve our credit metrics also. So, we're in continual dialogue. I think the other thing that I'd like to emphasize, around our ratings, we are in an excellent liquidity position now. We are funded all the way up until the startup of HPC with all the actions that we've taken. That included reducing the dividend by 72%. That brought in, approximately $525 million. We've reduced our sustaining capital by approximately $25 million. The expense reductions that we just talked about. We've got $2.5 billion of capacity on our credit facilities right now. And, we got the issuance of a $700 million MTN done, and that allowed us to pay down, the $500 million that was coming due in June. So we're in an excellent liquidity position, and I think the rating agencies look at that also, that we're in good shape there. So I hope that helps in kind of giving a little bit of color around, the rating agencies and our dialogue with them.
All right, that's great. Thanks, everybody.
Your next question is from the line of Robert Kwan with RBC Capital Markets.
Great, good morning. If I can come back to European storage, and Chris, you mentioned that a potential sale, I think you termed it opportunistically, you look at offers or inbounds. Just wondering, what would it take for you to actually formally restart that process?
Well, to be blunt, it would be an interesting offer from somebody for the business. We're not. What we're trying to be clear on here is we don't intend to restart a formal auction process for that business at this point. But however, if there was a one-off transaction that we found particularly compelling, I do believe the board would look at that with interest.
Turning to Heartland, is there anything that you can update even directionally on the contracting discussions? We've seen polypropylene prices, spot prices starting to tick up a little bit off the bottom. Does that help engage potential customers?
Oh, definitely. There's no doubt the spreads, as I mentioned, materially compressed. I think off the top of my head, the first half of the year, the spread, or the polypropylene spread price for polypropylene was around $1,000 US dollars per metric ton. And where historically, going back the last several years, they've averaged about 1,400. So that's a big compression in polypropylene. But we are seeing certainly green shoots in the long-term forecasts, and we do believe that the long-term fundamentals remain fully intact. The pandemic certainly has shown the value of plastics when it comes to keeping people safe, and polypropylene is a major component of that. So the fundamentals remain strong.
And is there any update as to your thoughts of providing more granular contract information to the market?
Well, it remains a subject of conversation at the board level. We do believe that the current decision to keep that confidential is the right one to protect the competitive tension around this. But the board is aware that transparency on that issue is an important factor, and just stay tuned.
If I can just finish with a granular question here around G&A. I don't know if this is for Brent, but I think on the last quarterly call, you'd mentioned you're expecting G&A of $190 to $200 million for this year, inclusive of, I think it was $30 million of HPC readiness. Just given what fell in the first half of the year and your cost savings, how are you tracking to that number right now?
Yeah, I actually think it's going to be a little bit better. Right now, I would say it's going to be around approximately 175 to 185 million. But the one cautionary note I put around that is around our long-term incentive plans. And obviously the expense for that is dependent upon our share price. So that can fluctuate, obviously depending on the share price. But, we're tracking quite strongly, we believe, versus what we had said before, Robert.
And just how much LTIPs you've embedded in for, call it, the second half, just so we can think about the materiality of that?
Yeah, Robert, I don't have that number in front of me. We could certainly follow up with you after the call on that.
Okay, that sounds great. Thank you.
Your next question is from the line of Robert Catellier with CIBC Capital.
Hey, good morning, everyone. I just wanted to just address the frac spreads. I'm not suggesting that you should look to hedge at the bottom here, but I'm wondering if the severity and depth of the downturn in the energy markets has changed your philosophy about maybe hedging the Cochrane exposure once prices get to a more normalized level?
I would say yes. Unequivocally, yes. I think we do need to take a more holistic view over how we transact on all the products we produce, whether it's from our off-gas business or the Cochrane facility. And so that will become part of our business plan. I would say it's more heading into 2021, because as you point out, now is not the right time to aggressively start hedging products. But we do intend to be quite thoughtful about how we manage our commodity risk exposure going into the future. Brent, do you have anything more you want to add to that?
No, I think you've covered it, Chris.
Okay, I just wanted to follow up on the credit rating discussion a bit. You guys have taken some actions to help your position in the past. Brent talked about the strong current liquidity and the need to get HPC started. But I'm curious of what happens in the context of starting HPC in 2022 if commodity prices haven't rebounded to the long-term average you're looking at for that EBITDA generation. Are there any other? Do you think that would increase impetus to consider other corporate actions that could shore up the credit rating, and what might those be?
The early, let's say the first 12 months of operation for HPC, there'll be a variety of factors going on, outside even just what the raw commodity prices are. These plants, they do have a ramp-up period, for example, so the plant availability won't be at peak in its first year. We do intend to provide some more granular guidance on that as we get closer to in-service. So yeah, we certainly won't be hitting that long-term average run rate of 450 to 500 million in year one, but there still will be material cash flow from that business, and that will be a materially positive impact on the credit rating, the credit ratios in and of itself.
Okay, so it's just a question then of, at this point of work, getting it in service and, just executing and I guess effectively relying on the recovery in the commodity prices across the business?
We'll put it this way. Obviously we're not in a position to provide the exact guidance on the EBITDA forecast, say for the first 12 months on this call, but we will definitely commit to providing transparency on that before we go into in service. But based on what we're seeing today in terms of the forecast commodity price deck for 2022 and our internal availability assumptions, we're pretty comfortable with where our credit ratios are going to be.
Okay. Thanks, guys.
Your next question is from the line of Rob Hope with Scotiabank.
Morning, everyone. A question on Heartland. I just want to know how you're managing or evolving the construction protocols there in the context of the COVID-19 world. When we saw, Edmonton cases kind of, move up a little bit in June, did you alter anything? And just can you provide some color on kind of the parameters you're using there?
Yeah, frankly, I couldn't be more pleased at how the team has adapted and responded to COVID-19 on site. We have not been COVID-free on site, but there has only been a handful of cases here over the last, 4 or 5 months. And that's a site where there's, a couple thousand people showing up every day. So do the math on that and how many people come in and out of the facility gate over that period of time. We've seen no community spread on site. Our controls have been very rigorous through mandating the uses of masks, managing the construction into small groups of manageable packages of people. We've got excellent contact tracing going on, so we're able to manage that when we do have an identified case. We have on-site temperature checks for all personnel as they enter the site. We feel quite confident that we're able to manage COVID-19 through the construction period here on an ongoing basis. Now, it has had, obviously, an impact to a degree on productivity, which is why the $500 million of capital cost increase we announced last quarter, 150 million of it was related to COVID-19, and a big driver for that 150 million is the fact that it's going to extend the schedule, we believe, by a few months, and that's really attributed to the productivity hits related to these mitigation measures. But it's all very manageable, we believe, for the next 2 years.
All right, thanks for that. And then just turning over to the frac spread business, we've seen olefinic been hit harder than paraffinic and not quite recover as much. Just want to get a sense of how you're viewing, the differences between olefinic versus paraffinic over the next little while.
I think it's Corey here. What we're seeing on our olefinic business is our main hit there is our Elky feed, which is sold off of a percentage of WTI, get hit hard. Elky feed's used ultimately for gasoline additive. With gasoline driving season down because of COVID, we're seeing continued challenges for that for the rest of 2020. But we see the paraffinic business remaining somewhat consistent.
Thank you.
Your next question is from the line of Andrew Kuske with Credit Suisse.
Thanks. Good morning. Maybe I'll start with just a big picture question. And when you look through HPC, and let's just say you're at a stabilized level of EBITDA generation into the future, and everything's gone reasonably well according to plan, well, what's the next strategic positioning move for Inter Pipeline?
Well, I think once HPC is up and running, one of the major things is going to be strengthening the balance sheet, frankly.
We want HPC running. We want it stable, as you pointed out. We want to make sure that the balance sheet is in very strong position. At that point in time, I think the next thing we would look at is the dividend. And as for, call it, thoughtful dividend increases into the future as business conditions allow. And then beyond that, it'll be just the continued advancement of sensible growth opportunities across all of our lines of business, be that petrochemical, oil sands, or conventional. Hopefully at that point in time, we will have exited, if not all of the bulk liquid storage business, but at least a material component of it, and seek to exit the rest of it over the next few years as conditions allow.
Okay, and then maybe the extension of that question or the follow-up is really when you think about the deleveraging and the dividend potential in the future, how does that interplay with just the sales process you've got underway? If you're very successful in the sales process, does that accelerate those activities? I mean, how do you think about the optionality?
Yeah, well, I think clearly if we were to find a partner for material interest in HPC, that immediately delevers the company in a very substantial way. So I think a lot of the heavy lifting will be done with one step. Regarding what the board may or may not do with the dividend between a hypothetical sale and the startup of HPC, I wouldn't want to speculate on that. I would just want to emphasize that the company is very focused on executing HPC and doing it in a prudent manner, protecting the balance sheet as best as we can in this environment. And I think the board that'd be first and foremost in their minds.
Okay, very helpful. And then just one final question for me, and it really comes down to your conventional business. And during the quarter, did you give any tariff concessions or any kind of support mechanisms to the producers in the area to try to encourage some of the volumes? And admittedly, the volumes are off a lot, but were there any incentive mechanisms put in place to effectively try to draw volume?
Jeff, do you want to answer
Andrew, it's Jeff. Maybe I'll. Yeah, good question, Andrew. We're constantly working with the producers before, during, and we'll continue after this period of time we're going through. So we have worked out some arrangements with a number of the producers to help them continue and at the same time benefit Inter Pipeline in the long term. So where we've have some arrangements in place, contracts in place, we've been able to look at extending certain aspects of it in exchange for some short-term relief, but really there hasn't been any material changes to our tolling structure. In fact, if I recall Q2, we've got a bit of a higher dollar per barrel number against the volumes moved than we did in the prior quarter in the prior year. So basically business as usual. We're having to get a little more creative, but all with an effort to benefit both the longevity of these arrangements for the pipeline as well as the producers in the shorter term.
Okay, that's great. Thank you very much.
Right.
Your final question is from the line of Patrick Kenny with the National Bank Financial.
Hey, good morning, guys. Just to follow up on your productivity comments there at HPC and staying on track with that early 22 in service date. Obviously, we're still stuck in phase 2 here in Alberta. Knock on wood that things don't get worse this fall or this winter, but can you just remind us how much buffer you have in that construction schedule, assuming current productivity levels remain, and also how much flex you might have to accelerate productivity, under the current COVID protocols, if the schedule does start to slip over the coming months. And I'm thinking, even if it meant absorbing additional costs, or is another cost overrun on the project just simply a hard no-fly zone internally? And if the in-service date slips a quarter or two, so be it.
Hey, Patrick, this is Jeff. I think Jeremy's still on as well, but we seem to have lost the guy that would like to answer that question for you. So Chris and Brent are just reconnecting. If you guys can just apologize for the trouble.
But Patrick, it's Jeremy. I can give you a bit of an insight on the HPC project. I mean, construction activities are certainly continuing to track according to our revised schedule, which is good. So we're still on target to meet or in-service date of early 2022. Over 50% of the overall work site has been completed, and our estimate of $4 billion is still the project cost, and we've actually de-risked about 70% of this of the cost through lump sum contracts, purchase orders, and substantial completed time and materials works. By the end of the year, we expect to be around 75 to 80% of costs being de-risks, and I think a lot of the FEED detailed engineering for both PDH and PP is also substantially completed as well. And then the focus right now is certainly on construction support and completing final documentation throughout the facility. So things are going very well. We've actually had approximately 2,600 daily workers on site, which has been able to ramp up a little faster than we were expecting through the initial COVID planning phase. But I think, as Chris mentioned a little bit earlier, we still got to be very cautious about this, so we're doing what we can in order to ensure that we can get the facility built, and maybe we can finish a little bit early. But as we stand here today, the expected in-service date is still going to be early 2022.
Okay, thanks for that, Jeremy. I realize it's a bit of a hypothetical, and I was just curious on how much cushion there might be from both a productivity and